$10 trillion every night. While you sleep, that number is not the US national debt. It is not the combined GDP of Germany and Japan. It is the size of a single market that resets completely before your alarm goes off. A market that most politicians cannot explain, that most journalists have never covered, that your bank has never mentioned to you once. And on at least 2 separate occasions in the last 20 years, it nearly stopped working entirely. The first time, the global economy almost collapsed. The second time, nobody called it a crisis at all. Both times, the Federal Reserve had to step in and essentially become the market itself. Because without it, nothing else functions. Not bonds, not stocks, not the commercial paper that corporations use to make payroll. It is called the repo market. And the reason you have never heard of it is in a strange way by design. Let me give you a simple picture. You own a Rolex, you need cash tonight. But you know you will have cash again by tomorrow morning. You do not want to sell the watch. You just need a bridge. So you walk into a pawn shop. You hand them the watch. They give you cash. Tomorrow you come back, return the cash plus a small fee, and you take your watch home. That is a repurchase agreement. That is repo, except in the real version, the watch is a United States Treasury bond. The pawn shop is a major bank, or a money market fund, or a hedge fund with a few $100 billion in assets. The fee is called the repo rate, and this transaction is happening thousands of times simultaneously, every single night with hundreds of billions of dollars per transaction. This is not a niche product. This is not a derivative. This is the basic plumbing of the entire financial system. And most of the people who argue loudly about the economy on television have never said the word repo in their lives. Here is why this market exists at all. Every major institution in finance, banks, hedge funds, pension funds, insurance companies has a basic operational problem. They hold assets that are locked up, bonds that mature in years, loans that pay back slowly, but they have obligations due today, counterparties to pay, positions to maintain. The gap between what they hold and what they owe in the short term is constant, and it is normal. Repo is how they bridge that gap. Overnight, every night. Bank A holds 10 billion in treasury bonds. They need cash today, not in 6 months. So they find Bank B agreed to temporarily hand over the bonds in exchange for cash and promise to buy them back tomorrow morning at a slightly higher price. The difference is the interest. The whole thing unwinds before most people have had breakfast. In good times, the repo rate is boring. It tracks the Federal Reserve's benchmark rate almost exactly. It barely moves. Nobody writes about it. It is background noise. And background noise is exactly what a $10 trillion system should never be. September 2008, Lehman Brothers files for bankruptcy. You know this part. The news covered it. Films were made about it. Books were written about it. But here is what almost none of those books explained. In the days that followed, the repo market did not slow down. It did not wobble. It stopped completely. Counterparties, who had been lending to each other overnights for decades, suddenly refused to accept each other's collateral. Not because the bonds were fraudulent. Not because the math was wrong. Because nobody could guarantee that the institution on the other side of the trade would still exist by morning. Think about that carefully. The entire repo market is built on one assumption, that the person who hands you the bonds tonight will be there to buy them back tomorrow. The moment that assumption breaks, the logic of the whole system inverts. Nobody lends. And when nobody lends, every institution that depends on overnight funding suddenly cannot fund its positions. So they sell. When everyone sells at once, prices collapse. And the collapse confirms the fear that started everything. It is not a slow leak. It is a self-sealing implosion. The Federal Reserve's response was extraordinary and largely invisible to the public. They injected trillions of dollars into the overnight market. They became the lender of last resort, not just for banks, but for the entire short-term funding system. They effectively replaced the market because the market had ceased to function. That worked. It was expensive and improvised and genuinely frightening to everyone who understood what they were looking at. But it worked. Now here is where it gets stranger. September 17th, 2019, not a crisis, not a war, not a recession, a completely ordinary Tuesday. The repo rate, which should have been sitting around 2%, spiked to 10% in a single morning for no reason that anyone could immediately identify. 10%, an overnight rate that is supposed to move in fractions of a point, went to 10% without warning. The Fed stepped in within hours, injecting tens of billions of dollars. Then again the next day, and the day after. For months, the Federal Reserve was operating as a daily repo desk because something in the plumbing had broken and nobody could fully explain why. The theories were reasonable in pieces. A large corporate tax payment deadline had pulled cash out of the system. Treasury bond issuance had been heavy, crowding out available reserves. Post-2008, regulations had changed the behavior of the banks who used to smooth these imbalances. All probably partially true, none fully satisfying. What matters is this. The repo market, which is supposed to be self-correcting, which is supposed to absorb these pressures automatically, failed to do so. and the Fed had to quietly become a permanent part of the market for months. The stock market barely noticed. Most people never heard about it. But if you knew where to look, something had been exposed. The assumption that this market could handle its own stress had been tested without a catastrophic trigger and had not held. Now let us go one level deeper, because this is where the real architecture lives. Remember that watch in the pawn shop? In the repo market, the pawn shop can take your watch and pledge it to someone else, while you still think you own it, while you fully expect to get it back tomorrow. This is called rehypothecation. It is legal, it is standard practice, and it means that a single Treasury bond can be used simultaneously as collateral for 3, 4, sometimes 5 separate transactions happening in parallel. In good times, this is celebrated. It stretches the available pool of safe assets. It keeps rates low. It makes the system efficient. But watch the failure mode. If one institution in that chain fails to return the bond, the collapse is not sequential. It is simultaneous. Every transaction downstream fails at the same moment. The chain does not fray. It snaps all at once. This is not a theoretical scenario. This is mechanically what happened in 2008. Lehman was a central node in dozens of these chains. Its failure did not cause a ripple. It caused multiple simultaneous breaks across the system in a matter of hours. And the chains today are longer than they were in 2008. Here is the uncomfortable position we are currently in. The Federal Reserve is more deeply embedded in short-term funding markets than at any point in its history. The 2008 crisis pushed them in. The 2019 episode pushed them further. The pandemic in 2020 pushed them further still. Every episode has required more official involvement than the last. The repo market functions. Let us be precise about that. The pipes are moving. The overnight rate is roughly where it should be most mornings. But the last 3 major stress events each required central bank intervention to resolve. That is not a coincidence to argue away easily. What it represents is a slow but measurable shift. The private market's ability to self-stabilize has been tested repeatedly and found insufficient without official backstops, which raises a question that the system itself cannot comfortably answer. If this market only functions smoothly because the Federal Reserve stands ready to inject unlimited liquidity at any moment, what exactly is it a market of? A genuine market allocates risk. It prices danger. It sends honest signals about where stress is accumulating. A permanently backstop system suppresses those signals. It allows leverage to grow quietly in the gaps. Because every participant believes the floor will hold, the risk does not disappear. It just becomes invisible until it is not. There is something deeply ironic at the center of all this. US government debt, which economists broadly agree is a long-term structural problem, is in the short term the primary collateral that keeps the overnight system liquid. The very thing that generates concern over decades is the thing that prevents a freeze tonight. The critics of deficit spending and the architects of financial stability are accidentally dependent on each other. So here's where we land. $10 trillion. Every night, invisible, load-bearing, dependent on a form of trust that cannot be manufactured on demand and cannot be restored quickly once it breaks. The system will probably work tomorrow. It will probably work next month. The Fed has the tools, the experience, and the institutional memory of the last 3 crises to respond faster than it did before. But here's the question worth sitting with. The repo market can go from functioning normally to not functioning at all in a matter of hours. In 2019, the Fed had roughly 3 hours of warning before it had to act. In 2008, it had less. Every improvement in crisis response requires learning from the previous crisis, which means every response is, by definition, calibrated to a version of the problem that has already happened. The one it is not practiced for is the one that matters. Nobody knows what that looks like, including the people whose entire job it is to know. And they will tell you with complete confidence that they have the tools to handle it. They said that in 2007 as well. To be fair, they eventually did. The word eventually is doing a lot of work in that sentence.